funny.
My For You pages look a little bit different.
Yeah.
Yeah. Glad you enjoyed.
Yeah, we're
Thank you guys so much for coming today. We have Hampsire Companies today. I'm really happy you guys came out. Hampsire Companies is a real estate private equity company. They do a lot of different types of asset classes. It's really interesting ones. We have Raj and Eshan here, who are both analysts and recent grads. So it's a little bit more of an intimate group, so I'm sure it'll be very conversational and you guys can ask a lot of questions. So yeah, without further ado, you guys introduce yourselves and Hampsire.
Thank you. It's good to be back at Rutgers. A little bit about me. So I graduated 4.5 years ago. Was the treasurer and the president of the Rutgers Real Estate Club. Now I work at the Hampsire Companies, which we do development as well as equity investment into pretty much every asset class. Currently, I'm a senior analyst there, working more so on the equity side and value-add component. Raj can talk about how his role differs a bit from mine. But yeah.
Alright, so for those of you who don't know, my name is Raj Mitaliya, and I graduated from Rutgers Business School in May of 24, so last year. I started working full-time in August 1st, so it's been about 8.5 months full-time, but I was an intern with the company for almost a year and 3 months. So in October of 2022, Eshan came to the Real Estate Club and he introduced the company like we're about to do, and he said he was looking for an intern to join him in the fall for this project called Valuations. And something that really struck out was that he said that he was going to interview every single candidate that submitted their resume, regardless of real estate experience, year, anything like that. And at the time, I didn't have any experience whatsoever, so I decided, let me just send in my resume. I can practice my interview skills at the very least. And after our call, he said that he thought I was a strong candidate and he liked me, but he went with someone else for the position. And he told me to reach out to these two managers for a summer internship, which I did, and then I ended up getting that position. But instead of starting in May, I ended up starting in January because another project came up. So I was interning from January 23 through March of 24. And Hampshire's a bit of a smaller company, so you wear a lot of different hats. And I touched year-end valuations. I spent some time with the multifamily team and the development team, learning about acquisitions, development, how to analyze markets, that kind of stuff. So ever since I started full-time, I've been focusing on self-storage, and then one of the other analysts left, so because of that vacancy, I got a little bit introduced to multifamily and industrial as well. So I have experience across a couple different asset classes, and my role is a little bit different than Eshan's because I work on the development team, so I mostly handle underwriting acquisitions. And yeah, you guys can ask me questions throughout the rest of our presentation. You want to?
Oh yeah. So the company started maybe 100 years ago. Yeah. Actually, it's 105 years. Fourth generation, privately owned. It's a family business, not mine or Rogers, but it's a family-owned business, which makes it quite interesting. As Raj mentioned, we work at a smaller company, which in real estate, that's a funky term because across both the publicly and privately owned assets, it's probably about $7 billion. So with a B, so that's pretty neat. But it's because it's a smaller firm, we work on a bunch of different asset classes, from acquisition to asset management to disposition. So that always keeps it interesting and fun. Yeah, a lot of good exposure to very seasoned, experienced veterans in the field. But yeah, the company started out more so in the brokerage realm, and then gravitated towards more so investment, and then into development. Primarily what the company's focused on right now is industrial and self-storage. In the past, there's been a significant development in multifamily and retail as well. So as times and markets and just sentiment changes, it's pivoted according to that. Stronghold is in New Jersey itself. That's the backyard, you could say. But across you know, most states, there's some or the other exposure. Easier to get into markets we don't really know in the easier asset classes, the triple nets, some more grounded development stuff. You know, like to play in the field we know. Yeah. Saying that, if there's any terminology or anything that I say that doesn't make sense, feel free to ask.
Let's say, what kind of industrial do you guys do?
Usually it's very nice Class A core market stuff. The company has a lot of stuff in Teterboro, which probably has the highest rents in New Jersey. And it's very interesting to see real estate that's owned for 50 years, where the rent is from then and after that lease expires, because these industrial leases are for very long periods of time, how that rent steps up. So very quickly, 20 years ago, the rent was $6 a foot. Right now it's 18. That's 3x. So your real estate value, because you know usually it's valued like a bond, your $20 million property is now 60 overnight. So pretty lucrative.
Not overnight though, like over the span of like decades.
Correct. Over decades, but your on paper value for realizing a new lease at market rent.
So, as mentioned, Hampshire has experience across several different asset classes, them being retail, industrial, self-storage, and multifamily. In terms of multifamily, the company, I'm just going to move around a little bit back and forth. So in terms of multifamily, the company has kind of like concentrated holdings in certain markets, one of them being Hackensack, New Jersey, and the theme is like Class A, meaning like very high quality, recently developed multifamily that has a focus on transit-oriented development and access to New York City. And these developments are in partnerships with companies that you may be familiar with. For those of you who are in real estate development, you guys have maybe heard of the Russo companies. So Hampshire has a lot of development and a strong partnership with them. So a lot of the deals that we've done in Hackensack and other markets across the state have been with them.
So speaking more on development and how Raj mentioned that usually where we develop there's some concentration, some stronghold. The reason for that is, well, you might have heard that New Jersey is probably the most difficult state to do development in. You could think about it from, people in the early years came through New York, then New Jersey, and spread out. So the legal systems and the different boards of, the different townships, the different planning boards are already in place, set in stone, very old, so it's really hard to get through to them. And so, as Raj also mentioned about the transit-oriented, usually in those areas, they have the UEZ, the Urban Enterprise Zone, or a designation called the Redevelopment Zone, where the township is giving an invitation to developers, come develop here, we want you guys to come in, make progress here, and that just gets it a lot easier through these planning boards, which can take many, many, many years, where there's not even a very clean, easy, simple playbook of this is what you do and this is what will happen. Very gray, very, very funky.
Yeah, a common theme in multifamily development across New Jersey. We've heard it from other professionals that have came like over the past couple weeks, but multifamily development in New Jersey is very difficult, and something that makes it more realistic and easier to pencil out is something called an opportunity zone, and this is kind of like that urban enterprise zone. It's basically like areas that are designated by the township or the state as these places or these areas need to be redeveloped. So the township will work with you to encourage that development. So another strategy that is very inviting to developers is something called a pilot. So a pilot is like a tax incentive that developers use, and it makes our returns better. So in most of the multifamily deals that the company has developed in like the last maybe like 5 to 10 years, you're going to see a pilot on there. And development without a pilot is unrealistic.
You know, a lot of times without the pilot, which if anyone does not know, that's payment in lieu of taxes. Instead of your tax bill, you pay this reduced payment as an alternative to the tax for a set amount of time, 10, 20, 15 years. It's a negotiation, there isn't any exact playbook. And a lot of times without that agreement in place, the deal does not pencil out. That a lot of times is the switch on off that makes something happen or not. And again, as Raj mentioned about a lot of stuff we develop is Class A. That's because without those top of the market rents, the deal does not pencil out. No matter how much we want to build Class B, very affordable stuff, the math doesn't pencil out. That's why there's a whole sector of affordable housing which is subsidized by the government.
Yeah, so as mentioned, in terms of multifamily, we look at transit-oriented, supply-constrained, rising home values, very high rents, and then we leverage relationships that we have with existing partners like Rusa Development. All right, so for self-storage, it's a little bit different. I can speak to self-storage because this is the asset class that I started off in. So at Hampshire, the deals that we have in the pipeline currently are self-storage and industrial. With multifamily, most of those deals have now been constructed. So instead of focusing on acquisitions, we're focusing on asset management, tracking the leasing, occupancy, seeing how they're doing, raising rents here and there when tenants leave. So that all comes into asset management. But for self-storage, we're actively acquiring, looking to develop new properties. And self-storage is unique. Most people look over it in terms of commercial real estate, but at Hampshire, we found that it's a really good opportunity to generate returns and push forward with developments. So for self-storage, Hampshire has built over 50 assets in the last 20 years or so across New Jersey and primarily like the East Coast. There's a couple deals in Florida that we're looking at. So most of them are in New Jersey. And then I don't have the chart here, but in terms of across the entire industry, not just Hampshire, the top 3 asset classes that have seen like the most amount of market share increase over the last, I think 5 to 10 years are self-storage, industrial, and data centers. So apart from Hampshire, there's a lot of other firms that have been deploying billions of dollars into self-storage, industrial, and data centers. For self-storage, we have a really strong relationship with Extra Space. So Extra Space owns some of the stores, but they also do a lot of third-party management. So that's similar to what Hampshire does, or that's where Hampshire gets involved. So in terms of third-party management, Hampshire will develop the self-storage building, and then they'll put in a little bit of equity. And then our bread and butter is not managing the self-storage. So we reach out to Extra Space for that, and they help out with the branding and the management. They do all the property management, the advertising, marketing. They help lease up the building. So that's a good example of a joint venture that we have with an institutional partner. So we've done mostly in terms of self-storage, we work with Extra Space, but we have worked with smaller operators too. Kind of like mom and pop operators where we'll do value add deals where we'll look at buying a mom and pop self-storage building, and then one of the ways that we can do value add is putting a REIT in there. So a REIT is kind of like an institutional firm that does specific asset classes. So Extra Space is a self-storage REIT. There's another one called CubeSmart that you guys might have heard of. Public Storage is another one. And then there's REITs across several asset classes. But in terms of self-storage REITs, Hampshire has the best relationship with Extra Space. So we try to always target them for our third-party management. So for industrial, this is another asset class that we're kind of pushing forward in. And Hampshire has a lot of experience with industrial in northern New Jersey and along like the port area. So with industrial, think big, massive warehouses, logistics and manufacturing, that kind of thing. So these are tens of thousands of square feet or even hundreds of thousands of square feet, and they're very large assets. And in terms of our partners, we've worked with some more institutions, Blackstone, Link Logistics, and recently we have this partnership with CalSTRS, which is the California Teachers Pension Fund. And this partnership, it was created in order, like CalSTRS is looking to deploy money into a specific market, and Hampshire has a lot of experience with northern New Jersey industrial, so we're kind of like the developer and CalSTRS is the LP. So just another example of how Hampshire is kind of like pushing forward with industrial development.
Yeah, so a lot of times what will happen is that a firm like Blackstone or BlackRock or any sort of pension fund where they want to invest in real estate, they won't go out into themselves, they'll cut a check to a firm like Hampshire with the more local expertise to execute.
You had a question?
Yeah, just on the basis of what you said, I was wondering, I'm assuming each industrial property that you guys develop has its own very specific requirements and whatnot. So do you guys sort of have a specialized team that works on, like, if there's a manufacturing team and they require certain machinery or whatever, you guys have a certain team that can do all of that, or do you like lease that to a third party?
Yeah, so a lot of times specifics of machinery, what exactly the tenant will use the space for, usually the tenant takes care of that themselves. What we do is more so delivering the physical real estate.
Right. Okay.
Of course, there's pieces of architecture and design that tie into that,
Right.
which we take care of, but the more specifics, they would have their own representatives that tie in with ours. So yeah, mostly on that.
Yeah. Feel free to ask questions if anyone else has any.
Yeah, so now that we've given an introduction on the company, a little bit more about what the company does, we thought we'd talk a bit more specific to what Raj and I do. So as mentioned, Raj sits more so on the development side, I'm more so on the equity side, where I focus on the company's existing portfolio of real estate as well as transaction as what we want to buy, what we want to sell of, the fund management, the asset management, the portfolio management that goes into it. So on a day-to-day, that can look like speaking with, okay, well, let me touch back to the asset classes. So apart from the asset classes we discussed already, we touch on office, retail, hospitals, hotels, large Fortune 500 company headquarters, which those are interesting. But yeah, and so what that day could look like is having a call with the hotel manager to see how the property is doing, where we need to improve performance, where our strategy is to improve that performance, or if we have a hospital that we are looking to sell, or if we have a multifamily that's not doing great, not doing fantastic, do we want to do a refi, maybe put in extra dollars to do renovation or not? Or if we have a tenant renewal for a large Fortune 500 company, let's say, it's $250,000 square feet, 250,000 square feet, and they need $20 a foot in TI to extend the lease. That's, what is that? $5 million in, no, actually that sounds less. Realistically, it could be maybe $100 million of just TI they want us to fund. How do we fund that out of our pockets? Questions like that is what I'll cover. And then Raj and I collaborate a lot on our quarterly or annual valuations of what is all of this real estate, 150, 200 different properties that we cover, what's it worth at the end of the day?
Yeah, so speaking a little bit more about valuations, Hampshire has several different funds, and you can think of each fund as kind of like a folder or a portfolio. Each portfolio has maybe like 10 to 25 different commercial real estate properties, all different asset classes, some of them on the board that you see. And what me and Eshan do on an annual basis is we go fund by fund, property by property, and we value each one. And we use approaches that you learn about in class. Some of them are called like the direct cap approach, or the sales comparable approach, replacement cost. Sometimes we're either acquiring or disposing the asset. So if there's an offer on the table, we'll use that offer as kind of like the year-end value. So as Eshan mentioned, in all these different funds, there's maybe a total of like 150 to 200 assets, and from August through April, we work on valuations. So hopefully this week, maybe sometime next week, we'll be done with valuations. We've been working on it since September. It's a very long and arduous process, but it's a good learning experience, because that's what I did. That's one of the jobs I did when I was an intern. We would go property by property, and I had the experience of looking at different asset classes. So for valuations, you consider several different metrics, variables. Who the tenant is, how long, how many years are left in their lease, is the building or asset currently occupied, is there going to be a refi? We go on CoStar to look at sales comps. We look for cap rates of different properties. What are they selling at? What are the cap rates? And then we also look at investor surveys. And using all these different resources, we come up with a value. Yeah, so that's one of the big projects that Eshan and I work on.
Well, what's the investor surveys?
So investor surveys, these are basically like big institutions like PwC and some of the brokerages like CBRE, Cushman & Wakefield, JLL. Every quarter or every half a year, they release these reports, and these reports basically go into, they're like market-wide surveys of where rates are at, where cap rates are at, discount rates, vacancies, that kind of stuff. So we reference these investor surveys. Like, let's say if we're looking at a market and there's the sales comps in the area are kind of like they're a little bit dry. Like, there haven't been too many sales in the area. Like, that's been a recent trend over like the last 1 or 2 years. The market's not doing too good right now, so people don't want to sell, and buyers are kind of reluctant to buy. So because of that, there's not a lot of sales comps. So we kind of have to reference other resources. One of them are investor surveys, and these are all public. If you guys search up like CBRE or like just self-storage outlook 2025, you'll see where you expect cap rates to be, that kind of stuff. Question?
How often do the evaluations need to be done?
So they need to be done annually or quarterly?
Quarterly.
Okay.
Annually.
Yes. So we mostly focus annually, but for certain, we track quarterly. Like if there's been a big phase change or a big, we call it like a trigger. If there's been some sort of big change, then we might go back once a quarter and edit it. But for the most part, it's annually.
Would you say that there are like certain parts of the evaluation process that would hold more weight rather than like other?
Hold more weight. Let's say if it's a triple net lease, that it's the real estate's effectively trading like a bond, and the tenant with these triple net leases, it's let's say a fast food chain. It's a Taco Bell, it's a Chick-fil-A, it's a Mavis tire store. That's a massive corporation. They have a credit rating, they have corporate bonds, and that real estate trades like a bond. That's very easy to to put a value on. Because with those investor surveys and cap rate reports that Raj mentioned, the data is there. There's a publicly listed cap rate for that, it's there. Where it gets more complicated, where that more weighting is a property that's in a funky situation, or it's something that we've just finished development on, or if it's something in a more complicated asset class, like hotels. A hotel is at the opposite end of the spectrum than a triple net. Triple net's easiest, you don't really have to do much. The hotel, there's a whole business side, management side, guest service side, that it's so involved, it's hard to even call it real estate anymore. That's a lot harder to value and a lot harder to sell. And if you want to think one step back, the cap rates are a lot higher on that than on a triple net, which is easy. Risk adjusted.
Yeah, and when we say triple net, for those of you who don't know, it's a form of lease, and when you think of triple net buildings, you can think of retail. So maybe like a CVS or Rite Aid or a Burger King. And without going off too much onto a tangent, so to value triple net buildings, we look at, this is one of the resources that we look at, and as you can see, it's full of different retail stores that you might be familiar with. For example, LA Fitness, Kohl's, Aldi, and if we just kind of scroll down a little bit, I'll send this out to the group me, but this is an example of one of the resources that we look at. We can see that the typical lease type is triple net. You can see the lease term, and you can see the cap rates. So what we do is we take the NOI of the property, like how much money that the property is earning after expenses, and we divide it by the cap rate, and that's how we get kind of like a gross value. So, and the gross value, we just subtract debt from it, and then we get the equity value. So that's what Eshan means when he says that these are very easy to value. They're straightforward. Most of the information is online, and we already have the rents from our own data. But yeah.
Yeah, this is the easiest side. It gets a lot harder from here.
Yeah.
You want to talk a little bit about development?
Yeah.
That you take group?
Yeah. So my the stuff that I do is a little bit different. So I'm kind of like I do a lot of underwriting, and I work a lot on different models. So every couple. Yeah. So maybe like once a week, maybe like multiple times a week, there's a new deal that comes across our table from the principals and managers. We're always looking to source new deals. For that CalSTRS partnership that we mentioned, we're working with brokers to actively find new deals. So these brokers are providing us deals, and then we're coming up with budgets for them, right? Like, how much do we expect this project to cost? And once we get that budget, we come up with what kind of money can we earn from the project, right? And using those two things, a budget and a projection, we can kind of model out the rest of the deal. And there's a lot more that goes into it, like a source and use. We look at tax projections, insurance expenses, how long we're gonna hold the asset, what kind of debt we're gonna have, is it gonna be a construction loan or is it gonna be a permanent loan, where interest rates are at, and the list just goes on and on. But if you guys are interested in working in commercial real estate, chances are this is gonna be one of the things that you do right away as soon as you graduate college and you start working at your first company. You're gonna be doing a lot of modeling on Excel. And that's kind of what I do. I started off modeling self-storage deals. I'm still doing that. And then recently, a couple months ago, one of the associates left, which means I got introduced to multifamily and industrial. So I've been cleaning up the models over there. And these models, they're kind of like it's the beginning of a commercial real estate deal, because you're not going to build something without knowing how much money you're going to earn from it. So the model is what tells you that. And yeah, so for example, this is an example of a budget. You've got this is very condensed. I shortened it on purpose so that we can see it over here, but there's different costs that go into this, and the total project cost at the bottom, you can see for this deal is like $13 million. And there's acquisition costs, like when you're acquiring a property, there's due diligence costs, like you're doing engineering surveys, you're getting approvals, entitlements, all that kind of stuff. So there's costs involved in this. Before any of the actual construction begins, you have to get all the approvals, necessary entitlements. And then after you get that, you can start with like the soft costs, hard costs, and then there's other costs like carry and that kind of stuff. It gets very nitty-gritty, and what you see here is a fraction of what it is. So this is the budget, and then this is an example of a projection. So as I mentioned, we have a pretty good relationship with Extra Space. So my boss, the asset manager, what he does is he's always looking for deals, and he's basically looking in markets where self-storage would be a good option. He's looking at, there's a metric called square foot per capita, which means how many square feet are there of self-storage per person. And like the lower the number, the more attractive it is, the more likely that there's a need for self-storage in the area. And for self-storage, you want to look at certain markets like around campus, like around universities, because it's very seasonal, right? So students are always looking for places to dump their stuff off, for the summer. Or
Tell about the 4Ds.
oh God, I
was
don't
on the
remember
slide too
actually.
before.
Huh?
It was on the slide
Oh,
too.
okay.
Death, divorce.
Oh yeah, there we go. All right, so I learned about this before. Death, divorce, downsizing, dislocation, and decluttering. So basically, people kind of overlook self-storage. Like maybe you guys see it when you're driving around, but these buildings are used by a lot of people, and it's almost similar to hotels in that there's a lot of property management that goes behind it, and fortunately, Extra Space takes care of that for us. But people use self-storage for different reasons. When people move around a lot, they need storage, and over the past couple of years, the storage industry has been hurt because people aren't buying or selling, they're not moving because the market's just not in a good place for that. So self-storage has kind of been at a lull, but when people start moving around again, we're gonna see a big spike in self-storage transactions. Yeah, death, divorce, downsizing, dislocation, and decluttering.
Basically any form of change, really.
Yeah, that's a good way to put it. Yeah, so this is kind of like a projection that I get from Extra Space. So when my asset manager finds a site that he's interested in, he'll reach out to Extra Space, and Extra Space is a national, probably international company. They've got properties all over the country. So we want to know where rates are. We want to know, like what kind of revenue we're going to generate, and that comes from this thing right here. It's called street rate, internet rate, and achieved rate. So these are per square foot. So basically, this is kind of like the foundation of our revenues and our expenses. So over here, this is just revenue, but the projection keeps going, and there's like expenses down here as well. So I take this and I take our budget, which is over here, and then I build a model. And from our model, there's tax, there's expenses, there's lots of expenses, insurance, property management, that kind of thing. But eventually we get to an NOI, and then after we get to an NOI, we have debt, right? So we have debt service payments that we make, because we hardly ever buy any of these properties all cash. We always get some kind of loan to do it, and because we're getting a loan, we have payments to pay. So the last thing is we have our cash flow after debt service, and then from here, after we get a cap rate, we get a value at sale. And then from this, you can see that I'm modeling to get an IRR and equity multiple. And what I'm describing is something that you'll do as an analyst. You might do it for multifamily, for office, different asset class, but you're gonna do a lot of modeling as an analyst. So something that I want to preach to you guys is, I have a list of resources at the end of the presentation, but you guys should try your best to understand commercial real estate models, how everything works. It's almost like a puzzle, and it takes a bit of time to get a grasp around the entire thing. I'm still learning, I'm still trying to make my models more efficient, and it makes sense over time, but you guys need to practice and get your reps in. So hopefully with some of the resources, you guys could get started on that. So this is modeling, and then part of my other job is we have existing multifamily self-storage properties, and I track the occupancy for that on a week-to-week basis. For some properties, they're like, let's say a property that just got built, it's gonna see almost like a massive, almost like exponential growth in occupancy. And that's something that we've been seeing on, we just finished developing multifamily property, and over the past couple weeks, the occupancy, the leasing has almost skyrocketed. And then versus when the property is stabilized, it kind of stays calm around that 90-95%. And then these are some of the resources that I was talking about earlier. If you guys want to take a picture of this, I think it's a pretty comprehensive list of organizations and different resources that you guys should look into to learn more about commercial real estate. And the stuff on the right is kind of technical skills. So for industrial, for retail, for office, a lot of the modeling that you do is done on this platform called Argus. So the Rutgers Center for Real Estate sponsors Argus memberships in this class called Commercial Debt Markets. So you don't have to worry about paying for that, but it's always good to get a head start. And then these two are pretty good. Adventures in Commercial Real Estate and Project Destined. I'm sure you guys have heard of both programs, but they're catered towards teaching students about commercial real estate, different asset classes, that kind of thing. And it's the more you participate in these kinds of events, the more you learn about one, modeling, and two, about different asset classes, what you're interested in. And the commercial real estate industry is pretty vast. Whether you want to do traditional development, private equity, asset management, it's wide, and doing these programs will help you learn more about commercial real estate.
Yeah, thank you for going over the model and some of the things we look at when initially looking at a deal. If you guys have any kind of specific questions, more so to the sectors of the real estate or what's happening in the market, to what we work in contrast from working at a large firm or a more smaller, more entrepreneurial firm, or what I do more so in the asset management segment, feel free to ask.
When you guys are doing redevelopment, do you typically keep the property and refinance at the end, or do you sell?
It depends. Well, like everything, it depends.
Yeah.
Part of it's what's the market looking like. Part of it is, are things hot? Are there a lot of buyers? So institutional capital, that depends on the deal size itself. But if we are doing a redevelopment, it becomes maybe, let's say, a math equation. What we could sell it for today, if that makes a lot of sense after doing the redevelopment, if a buyer comes along and they're like, we're gonna give you this much money, we're like, that's a lot of profit, we'll take it. If it's pretty slim, and we're more confident about holding it, running it down the line, and the cap stack makes sense, we'll hold it. So it's very case by case. It's not a one stop, one stop.
And then another question: with the investors that you have, how do you keep kind of stable returns when you have, for example, when you refinance or you sell a property, you have a lot of cash coming back in. How do you ensure that your money kind of stays active and you don't have cash just sitting there waiting for the next deal?
So that's an interesting question. So what happens in real estate is that there's a variety of structures. You have funds that you put in money once and it's spread across 20, 30 however many properties. That's very stable. You got your cash flow rent coming in, you can make distributions, very simple. Then you have direct investments where we're raising capital for one single property, and that's where you'll have some more roller coaster. Sometimes it's making a lot of money, sometimes it might not, sometimes we need investors to actually put money in, also known as a capital call. And there's every kind of mix in between. But yeah, that's of course a big question that comes up. And that's where kind of my piece comes in the picture more of, you know, if a tenant goes out, how do we replace that tenant? If something happens to the property and we need to put up many, many millions of dollars, how do we do that? And if we don't have the capital on hand at the property, where do we source it from? Is it a loan? Who's the lender? At what rate? Or based on a piece of paper with an agreement from the tenant, which would be a credit tenant in this case, can we get dollars directly for that from someone else? Or do we get preferred equity? So it's a deck of cards. Which card do we want to play?
A lot of the developments that you guys do require, expert architecture firms and construction companies and whatnot. So how do you go about building and maintaining those third-party relationships with these people that end up sort of constructing your properties?
That's a good question. So something that we mentioned before is that Hampshire is a small company. It's a small company when you compare to, let's say, Blackstone, which is huge. They're the largest. But within the field that Hampshire plays in, which is New Jersey, Hampshire is one of the largest, most well-known, reputed firms in the state. With that, a lot of times those architecture, engineering, construction firms are kind of trying to come to us to get us to sign a contract with them. Because let's say there's a dozen concrete companies, dozen engineering firms, they'll want to get the contract from us, so yeah. But that's something that comes with scale, time, and yes, relationships of who can you trust? Because everyone has a pitch of why I'm the best, why I'm gonna get this done the fastest and the cheapest time. How much truth is there to that? That's a tougher question.
Yeah, Hampshire has decades of experience with development, and you'll see some of the same names come up for architects or contractors, and over time, as Eshan said, we build good relationships with them, so we know like who to trust, who to call for different tasks.
Yeah.
But whether it's like civil engineering, architectural drawings, general contractors, that kind of thing. Like we have someone in mind for each specific development, whether it's any asset class.
Yeah, and then there's more specific people at the firm who focus just on that, making sure they're doing their job right. Because if something goes wrong, at the end of the day, as the owner of the physical real estate, the money comes out of our pocket, and anything messes up, it's costing us, not the engineer. And those are expensive issues. It's just gonna start out 7 digits without any question. Of course, it's about scale as well, but any issue is an expensive issue.
I'm kind of curious how you guys are deploying technology into the business, the business itself. So at Hampshire, outside of the Excel modeling process, how are you guys deploying other technology to kind of streamline valuation and make the models more efficient, more accurate, that kind of stuff?
Yeah, that's a good question. Well, historically, real estate is an old field that it's very low tech. Right now, we probably have the most tech we have in real estate than ever before. But then again, compared to other industries, it's way behind. It's very archaic. A lot of the stuff that Raj and I do, we still don't have all the pieces that we would like to have. A lot of it is still guesswork. A lot of stuff is, do we just feel confident at the core about this? If everything was there to piece it together, it it wouldn't be as lucrative. But then again, I mean, a lot of the stuff about real estate, what we've mentioned to you about the underwriting, if you step back, that's really just the plan. Going out and getting the approvals, actually buying the real estate, like, how do you actually buy this real estate? It's a lot more complicated than you think. And how do we actually sign this lease? Like signing a lease with a credit tag for $20 million a year, or the lease term $400 million per lease. How do you actually go about navigating that? And that would cost you another $100 million just to get that signed. It takes a lot more than the Excel that we do. I don't know if that segued a bit, but yeah, no, there's not too much crazy tech. A lot of it, again, is the expertise, the relationship, who you know in the industry, who's got the right knowledge and the right connections. Real estate classically is a connection-based business.
In terms of some of the specific resources we use, I'm sure you guys have heard of CoStar. There's other ones as well. We've recently started using this one called Crexi, and Crexi tells us if you search up a property and you find its address, or you just kind of like plot it on the map, you can see previous ownership data, and sometimes you can even see mortgage data. So we can see, is the property underwater? Is it healthy? Based on that kind of stuff, we can kind of figure out how we want to acquire a certain asset. So we've been doing that a little bit for self-storage with the mom and pop stores. We've been seeing, contacting the owners directly, seeing if they're interested in selling the property. So Crexi is another one. We use this other platform called Radius Plus. It's basically like the CoStar, but for self-storage. We can see, all self-storage, properties across the nation. We can see what the rates are, that kind of stuff. So we use several different platforms to do market research to figure out, how much money that we can earn for properties. And then in terms of, making our models as efficient as possible, that's something that I'm trying to work on right now. It takes a lot of time, and there's like different macros and VBAs that you can do that I want to start doing. Like, we just finished valuation, so a lot of time has been spent on that. But for the next couple months, I want to really hone down like modeling skills, make them as efficient as possible. Like, something that we do is so for interest rates, right? There's this company called Kadam Financial, and it's very popular. People all across like finance, commercial real estate, they use it to get interest rates. What we expect SOFR to be at this time. So every single time that I'm working on a new model, I have to go on Kadam Financial. I have to download the SOFR curve, and then I have to like manually input it into my model. But after networking with someone, they told me that I can do that like automatically through a macro. So as soon as I get some time, that's like one of the first things I want to do. Like, if I can do enough of these things, I can make these models more efficient, and I can save myself time, and everything will just become a little bit cleaner, a little bit more aesthetic. So that's something that is hopefully gonna happen over the span of the next couple months. But if you guys are all like smart people, so if there's stuff that different platforms or applications that you guys are using to make your models more efficient, then feel free to let me know. I come here too. I like learning, so just let me know. Yeah, Keith.
Eshan, you mentioned before, like sometimes like you don't really have like all the best like or up-to-date data. If you did like a kind of a core feeling, like what is the kind of stuff that like that's again like you said, like that's where the opportunity in real estate is. This is not like a commodity where all the data is out there. Like you can find those like opportunities. What are some of the things that when you see it, you're like, hey, like it's like not like a ton of like spotlight on this, but like like you have a good feeling about like what's maybe an example that you've like worked on, or like what do you kind of look for? Like how do you get to that?
A lot of it is local expertise. It's hard to tell in a market you have no experience in, that you're looking at for the first time, like what's really a diamond in a rough and what really just is bad. Especially with real estate, there's nuances so deep into the zoning, the town specifically. This town is not going to let anyone develop anything at all. And if you buy that, you're getting nowhere. You're losing money. And there's other towns that are open to it, and then it's an equation of all that. Then there's also a piece of, you know, who can get the deal done. When it comes to all these approvals, that's not always the same of what were we pitching, but how is it being pitched. When it comes to, what market specifically, some of what Raj said definitely helps. So what the public data is there, but it's, you could say broadly, where there is not development today, but will be in 10 years. That's on the precipice, on the cusp of revival. That's where you'd see the most tailwind. If it's not the greatest market, then you're not going to see the appreciation, the value add. If it's too great of a market, it's at the point of it's too stable that your returns are so slim because you paid so much just to get in the game. So it's a bit of a balancing act, and then based on different investors, there's different risk tolerances. Someone who wants something very stable, they will go into that core market and they'll be happy there. Someone who wants the most opportunistic, outlandish returns, they'll go into more not mature market, but they'll deal with other, let's say, issues, plus and minus, pros and cons with that as well. So there's a risk tolerance piece for sure.
Yeah.
How do you see like the storage part of commercial real estate like evolving or changing in the next 5 years?
So, I guess it depends on where the overall market is, but self-storage is definitely going to keep growing a little bit, and it depends, as we said earlier, the 4 or 5 Ds, but I think one of the biggest, pushes for self-storage is people moving. That's one of the reasons why people use self-storage, and right now people aren't really moving. So I think when the market heats back up a little bit, and when people are more, they're ready to make transactions, that's when there's going to be a push for self-storage. But at Hampshire, we're still moving forward self-storage. I guess where do we see self-storage growing in 5 years? That was your question.
We're still bullish on
Yeah.
it. I mean, something interesting that happens in real estate is there's a asset class of the day, of the year, where a few years ago, the hot topic asset class that everyone wants to get into was multifamily. Everything becomes pretty cyclical, where all developers want to get into multifamily. Now you could say, in some markets, there's too much multifamily. And you can see that in market rents reducing. Right now, there's a lot of demand into self-storage, but even more into data centers. That's the brand new thing that no one really knows about, that we're looking into as well, that the barrier to entry is probably the highest. Because now it's not just real estate, but the biggest question we look at is how do we get the power there? Because what makes it unique is the amount of power, energy needed there. And with those deals so big, it's not just what you can build, you need government level approval. Like they need to be on board before you can go build $1 billion data center. So without that green light, it's not happening. But to go back to your question, we're so bullish. There's a lot of factors unique to self-storage, like the year-over-year growth, that make it a lot more lucrative than asset classes.
I'm kind of curious if you guys have looked at all like sustainability, like projects relating to like solar paneling, those kind of things.
Yeah, so we do do a little bit of work with solar, but we don't, do that ourselves. We reach out to contractors, and we have a pretty good relationship. We get lots of tax incentives for installing solar on our properties, and in some scenarios, the cost to install the solar is completely free. The solar generates money or savings, and sometimes the installer of the solar will take some of that, and then just having solar on your property increases the value of it, and for investors, there's tax benefits and that kind of stuff. So for every single deal, we don't look to have solar necessarily, but we have a partnership with I don't know the company name, but he's this individual guy. His name's Solar Dave. That's not his company name, but he's very well versed in solar. He's kind of like a one-man team, but he hires his own contractors, subcontractors, and we've been doing that on our self-storage because solar is very easy to install on the roofs. It doesn't need a lot of maintenance, and whatever maintenance it does need, our solar vendor takes care of that himself at little cost to us. So the benefits and the power that the solar generates, it's very good for our investors. So we're not necessarily like having solar on the project isn't like a make or break, but if the cards are right, we'll go for it.
Yeah, there's a handful of firms that all they do is selling solar, where their business is they put the solar panel on different landlords' property, so they'll go around town offering everyone solar, and what's in it for them is they'll take the solar, sell it back to the grid, make a profit there, and they'll give us, let's say, the panels to keep it on a roof for a discounted price or free, and then we get certain tax benefits as owners having solar on their property.
Yeah, there's like roof leases and that kind of stuff, but I'm not super well versed into solar, but I know that we do consider it for different real estate deals.
Doing like preliminary like underwriting, what kind of like metrics do you determine like whether a project is feasible or not? Because I'm sure like for the REIT, it's gonna have like different metrics than like your in-house stuff. So like on your model, you had like a 1.7 EM and like 12% IRR. Like, would that be like for let's say self-storage? Like, okay, that's like a return that we're comfortable with, or like what kind of? I guess that also depends on like the market as well.
Yeah.
Like in general.
Just looking at this is somewhat of a low IRR for self-storage. So let me talk a little bit about, I guess, like the different hold periods for some of our asset classes. For multifamily, because these deals have tax incentives and like, pilots, they're built on opportunity zones, those generally tend to be longer term holds. I don't think we've sold any multifamily recently. The only one that we have sold is because that fund was closing, so all those assets needed to get disposed. But for self-storage, these properties are typically a 5 to 10 year hold, closer to 5 years, and the shorter the hold period, the higher the IRR. So for self-storage, we have two different strategies. The first strategy is we're building the property, and then we're building it with a construction loan, and then we sell it before refinancing. So the profits that we get from selling the property, we pay off our construction loan, we have money, and then we either 1031 into another deal, or we just kind of like back off. Or the other deal is we'll refinance the property, and then because we refinance, that turns into a longer term hold, like a 10-year hold. So that's self-storage. For industrial, it's super unique because we're building these properties after getting approvals. Construction generally takes 12 to 18 months for most asset classes. So 12 to 18 months. And then for industrial, we usually model out 6 months of vacancy or 6 months of free rent. So that's, call it 18 months plus another 6 months. So that's 2 years. And then we expect the property to start generating cash flow 6 months after that. So for industrial, with this new partnership that we have, these deals and the hold periods that we're looking at are extremely small, like anywhere from 2.5 to 3 years, because we're looking to get in, develop the properties, and then we're selling it to, like, we have small equity. Hampshire, where kind of like the real estate private equity comes in, is that we make most of our money on like fees, and we put in very little equity into these deals. We work with institutions or high net worth families, that kind of stuff. They're kind of like the LPs. They raise all the capital, and we put in very little amounts of money. So with this CalSTRS deal, we're developing the property, we're collecting fees on management, property management, developer fees, construction management fees, that kind of stuff. And then we're selling it to them, and they're looking for stable industrial deals, and these leases are anywhere from like 5 to 15 years. So, and it's like it's core Class A. So once these properties are tenanted, they're very like safe and reliable. So they can be put inside a fund for CalSTRS, and then that's one of the ways that CalSTRS will raise money for its investors, whether that's teachers or institutions or whatever else. So to answer your question, for self-storage, mostly 5 years, occasionally 5 to 10 years. For industrial, very, very short. For in terms of new Class A development, and then for multifamily, it's usually a little bit longer term, maybe like 5 to 10 years. What year are you guys? Are you freshmen? Okay. Sophomores? Juniors? Seniors? Okay. For the freshmen and the sophomores, what interests you about commercial real estate? And are you guys thinking about pursuing any other industries? Residential? Like real estate development, asset management? Is there something in specific that interests you? Like, do you have any questions that we could help answer? Okay. Sorry for putting you on the spot. What about you guys? Is there like a specific part of commercial real estate or finance that you guys are leaning towards?
Yeah, I would say for commercial real estate, I think the kind of the financing side of things that interests me. To be honest with development, I'm not as risk tolerant, so like that side of things is like for me not as interesting, but kind of taking a step back and being the better part of the capital stack, that's more interesting to me.
Yeah, definitely. I agree with you. Like, not sure if you were here, but like maybe a couple months ago, this guy named Preston came in, and he worked at Newmark, and he worked on like the debt capital markets team. So his team worked across like all asset classes, providing the financing, or like bringing the buyer, the seller together for the financing. So there's lots of opportunities in debt and financing. What about you? Do you know what you want to do in terms of commercial real estate?
I mean, I don't really know what I want to do, but I'm interested more in like you said, the financing stuff, the valuations. I like the financial modeling aspect of it, big into like math, so pretty interesting. I think development's pretty cool, but again, I'm more not as risk tolerant like he said, so I'd stay away a little bit from development. Maybe one day want to invest on my own too. It's probably my biggest thing. Get some returns on my capital.
Yeah.
So let's like pivot a bit to career advice. If you guys have any questions there, I mean, the amount of segments within real estate that you only really figure out or learn of, or niches, once you're in it, is ridiculous. When I was in college, I was like, there's development, and then there's equity, and that's it. Then you get into it, and then there's debt and different specializations into the asset classes, and then the whole vertical pipeline of construction, engineering, and being a broker, or being a broker in a specific niche or special situations. There's a billion different avenues that it definitely takes a lot more kind of digging into to figure out. But then there's the whole thing of, do you want to be on a more institutional side, working on Park Ave for a mega fund, or do you want to be at a more, let's say, regional developer investor like Hampshire, or at a smaller one that's far more entrepreneurial, smaller team, that you're going to get more into the weeds of, let's say, more into even property management, that you're dealing with tenants. So it's a whole spectrum of where do you want to sit in that.
Eshan, what drew you to Hampshire in the beginning? And kind of like, where do you kind of see yourself now? Where do you kind of want to go in your career?
So it's interesting. That's a great question. That picture for myself has evolved a lot. When I was in college, I was like, I want to be the biggest developer. Like going to New York, I'm like, I want to build that tower right there. I'm going to do that one day. Then you get into it, then like, holy shit. It takes a lot of money, a lot more money to back that up, and it's not a one-man show. the amount of professionals that work on developing any given building is ridiculous. Hundreds, no matter really what the scale is. Once you get into legal, engineering, architecture, there's a lot of people. After that, I figured out like, okay, I like the equity side more. I like the number side, the math side, the financials. That's what calls me. What can we do to make this X, Y, Z return at the end of the day? I like that piece. And so that's where I am, and that's where I plan to stick with. Then, personally on the side, build a portfolio on my own. Initially, I thought of, why don't I have a goal of starting my own fund one day, raise dollars, be a GP, raise LP dollars, and go to town, invest in properties. Then I learned that the amount of stuff you have to deal with, upset investors, to now having all these back office departments, investor relations, finance and accounting, and compliance teams. And it becomes a very complex equation. How do you manage all that? And working at Hampshire, we work with a lot of people from those mega funds to regional developers and engineers, and to private investors, high net worth individuals, families, businesses, and the people who I found to be the happiest was the guy who just operates on his own and just builds a portfolio over time and just does that. And that's my picture now. So.
What's the work-life balance in your positions?
I feel like we don't work at kind of like a traditional real estate private equity company. Our company started off as a family, and it's still a family company, but it's grown to 66 full-time employees. So to answer your question, I feel like it's pretty calm. It's nothing too drastic. I work for the most part a 9 to 5. I usually get in at like 8:20, and I leave at like 5:30. Today, me and Eshan left partly because we knew we had this in the evening, so we left a little bit later, but also we were doing work until right before we left. So today, we worked till 6:30, but that was probably one of the latest days I've worked in my last 8.5 months here at Hampshire. So I feel like, to answer your question, work-life balance is very good. Mondays, Fridays remote. Drive to Morristown, Tuesday, Wednesday, Thursday. It's good, I like it.
Yeah, it's pretty routine, 45 to 50 hours, I'd say. But those 50 can get hectic. Especially when some of these things everything's very mission critical.
Mm-hmm.
Especially when the problem comes up, it's an expensive problem. But no, we're definitely not doing investment banking type 80, 100 hours. We're not doing that.
Yeah. As someone who works on kind of the acquisitions front, when things are moving quickly. So it's like you have to it's like something will come up immediately, and the deadline is almost also immediate. So it's like there's three people that do analytics at the company, and me and Eshan are two of them. So it's we're working across several different asset classes, and it's sometimes juggling priorities is a bit of a challenge, but everyone is very understanding. And small company, so the same deals I'm working on, my managers are also aware of, so it's very understanding. It's nice.
Which of the asset classes is your favorite?
So when I was an intern, we had kind of a traditional summer internship. It was me and 2 other interns, and each intern got assigned to multifamily. Each intern got assigned to an asset class. So I got assigned to multifamily, another intern to self-storage, another to industrial, and I was like, yes, I got assigned to multifamily, the most exciting asset class. But looking back at multifamily, it's very traditional, and I feel like people always consider multifamily in terms of personal development or acquisitions, or maybe they want to end up working for a mega fund or a company doing multifamily acquisition or development. But right now, for the last 2 or 3 weeks, I've been updating the models of the multifamily deals, and I don't know, I feel like self-storage and industrial is a lot more interesting. Like it's unique, you know, like the different reasons why people do it, and it's what I think is super interesting is that like the way that different asset classes work together. So like if a company moves to, you know, like Austin, Texas, right? Like that's office, and then, you know, a bunch of housing is gonna be developed, right? That's multifamily. And then, you know, because of all the housing development that's going on, you know, maybe extra space is going to come in and they're going to build a self-storage because, you know, people need to store their stuff. And then, you know, maybe a couple malls will come up and that's like retail. So, I don't know, to answer your question, I think industrial, I've been reading up a little bit about data centers. I think they're also very interesting. The company is considering one, so I'm trying to be as involved as possible. So industrial data centers are probably like the most interesting, and then self-storage, multifamily.
Yeah, so good thing at Hampshire, or at least, you know, what we do kind of goes back to what tranche of company we want to work for. The benefit that we have at Hampshire is we pretty much cover all the asset classes, which gives a nice understanding of real estate as a whole. My answer is a little different from Raj. My favorite is hotels. I just like the human-centric component of it, that it goes down to human psychology and you know, apart from, let me step back. So in a hotel, you have two streams of income. You have the rooms, and then you have food and beverage. And depending on what type of hotel it is and where it's located, it's either going to be a business hotel or a leisure hotel. If it's in a downtown area where there's a conference center, that's a business hotel. If it's up at a ski mountain, that's a leisure hotel. And so those dynamics play into it heavily. The seasonality, you have a peak season, off season. You have to make all your money in the on season, because in the off season, you're just losing money every month. So you have to recover that. So those variations, I enjoy that. I also like the multifamily and retail a bit more, just because the human nature takes into that more. Which retail center is going to do well really draws onto how much foot traffic there is to it. It's really that simple. And especially as well with the multifamily, where do people want to live? So that human nature centric part of real estate is what I enjoy. So those are my three favorite.
Yeah, kind of following up on your point about hotels, what do you think about boutique hotels as a real estate investment? As in, you know, like you're...
So when we mention about risk returns, hotels are the highest of values. It's the riskiest, but if it does well, it's going to make the highest returns that you could never. It's in a different league to any other asset class. When it comes to boutique hotels specifically, there's a lot of firms few, that focus just on, you know, top dollar, you know, very niche, ultra luxury hotels. Gotta have an appetite for them, and that's gotta be your thing and your thing only. Because that's one of those things where it's there today, it's gone tomorrow. This hotel is hot today, and again, that's where the whole human-centric piece comes in. How's the service? How's the food? How are guests feeling? If they don't feel good about their visit today, they're not going to come tomorrow. If there's a bad review online today, that's reducing your business tomorrow. So, a hotel that does well today and has a great valuation, business goes down, or just ages out. A new hotel today is old 10 years from now, and you have to keep upgrading, renovating, that it takes a lot more upkeep, a lot of management, so your returns are better, but if it does not go well, you're losing a lot more than if you put that money into a multifamily or industrial or one of those triple nets.
What do you find most fulfilling about your role?
I feel like commercial real estate impacts a lot of people, and we bring value to communities. You know, like maybe my my underwriting different models doesn't really do that, but I feel like on a bigger picture, it's like even if my company decides to build a self-storage building and I underwrote that deal, it's like that tax revenue that the building generates, right? It gets given to the township or the municipality, and that goes to the schools or to parks and that kind of stuff. And I feel like what I like about real estate is that like the work I do, like will potentially create real value in the future. Whereas if you work in like traditional finance or banking, it's like doing M&A on like million or billion-dollar companies. It's like I don't know. It's hard to see how that truly impacts people. But it's like in the future, like Eshan, like I'm sure a lot of people like you, I want to own and acquire my own properties, and some of those will definitely be residential. So it's like in the future, I want to be like a good landlord who provides reasonable housing to people, and I feel like that's something that would be fulfilling. Not right now because I can't do it right now, but I'm learning how to do it right now. So I think that's something that's fulfilling about my job.
So for me, what I find fulfilling about real estate is that it has an impact on the broader population. If you really think about a different city, New York, London, Tokyo, Amsterdam, what do you think of? You think about the skyline, the architecture. What is that? That's real estate. And so, in my mind, to be able to put together a building that's going to last for hundreds of years, that's making an impact, providing a value beyond me, beyond the company, beyond anything else. That's helping people from all over. And that's the part of real estate that kind of it's in plain sight but invisible, is that someone had to go out and build it, and other people benefit from it, and it's what kind of builds society is the real estate. A lot of people want to think real estate is their house, but you think it's a full ecosystem. Where you went to school, that's real estate. The store, that's real estate. The movie theater, someone had to build that, didn't come out of nowhere. The car dealership where you buy a car, someone built that, that's real estate. So when you talk about what's in a city, what's not there, or city has nothing fun, it ties out to if someone built real estate there or not. So that's what I like about it. So the impact that goes beyond oneself.
Thank you for sharing.
Something else that I want to mention is when I was I guess I'm like only a year older than some of you guys, but I feel like something that would have benefited me earlier was deciding. I knew I wanted to work in commercial real estate, but I didn't know if I wanted to work for a small company, a big company, in a specific asset class across multiple. And I feel like at Hampshire I've found that I work across several asset classes, which I find most interesting. So I think it would be beneficial to all you people if you did some networking or you did some reading and you found out, one, which part of commercial real estate you want to be involved in, and two, what asset class most interests you. Whether you want to be someone like me or Eshan, where we work across several asset classes, kind of like a jack of all trades, master of none, or whether you want to specialize in boutique hotels or data centers or something like that. Because I feel like there's pros and cons to either one, like being a generalist or being an expert in a very niche area. Like either of them has benefits, and it would do all of you guys a lot of good if you spent some time thinking about where you want to end up. That's something that I wish I did more thinking about.
Cool. That's it. Thank you very much, Raji. Eshan? I was kind of emotional at the end. I was like, man, I love real estate. You guys, sometimes I forget, like, oh, it's just like modeling and stuff, but no, yeah, it's really is, everything. So yeah, thanks for coming, guys. Of course.
Thank you for having us.
Yeah. We guys stay behind if you have questions.
Yeah.
Perfect. Thanks for coming, guys. And these are really good resources as well near the end.
Oh yeah. Take pictures, guys.
Yeah.
Did you guys do Project Destin?
Yeah, I'm still doing it a little bit.
Cedric.
Does anyone have any questions? Yes? No? All right.
What was the name of that website?
Yeah, Crexi. So CREXI.
And that has a bunch of different.
Well, it's also free.
Think about it. Even if let's just say
It's pretty good. You can see like some of the information, that information.
politics that go into it, it's
And that's across like a variety of different types of property, like it can be industrial, it's
yeah, just a question of real estate is the most expensive sector to invest in. Oh, that's really scanning it. That's what I said at first. It was like,
You have to do certain of these things. What are you trying to do? You want to work as a big company one day, like, maybe it's not what's that right now, but in the future it might be like
small ones and complex.
And I feel like
They're spread it,
you go on their website and you see all the big
very
commercial like Brookfield, BK, Logistics, Invesco, all these big like
Another thing is when you go to buy commercial,
have some sort of program with
brokers,
so I feel like the bridge program
this
is
is
kind of
nice.
like still like most valuable, but I
I'm
think
just
you
gonna
get
go with
that
that.
until you do like the real estate level one or level three.
it's tough. Maybe it's easy. I'll do it. I think it has to be balanced with having that
Some of the stuff we went over today, like
plus have that personal
you're
vision.
gonna say the same stuff over and over and over again, but it's like the more you hammer that in,
What about you?
like second nature. It's like 9 months in.
I'm real estate introduction.
But I'm still learning up to like stuff like you can take classes for and I feel like what project that's good at is like kind of like the reps. And for modeling, like you take time. I don't know how to model really like 0 to 100 really well. Like I can do it, but it's like every year and then I'm in class, Eshan or my other subject for help.
Oh,
So
okay.
it's like
I know a lot of people that do like I see them all on Instagram.
Yeah.
and you already knowing how to do this, like from start to finish, it becomes so valuable. Like any company will want to do that because otherwise companies have to invest resources into teaching you how to model. So I feel like
Had a great experience with that.
you know how like tech students, like people that do computer science, like lead code, like for sure have that.
Working on integrated house.
Like I'm serious. Like yeah.
I really love like especially with work where he does programming, he does programming, he does construction management. And stuff like that. Like whenever we're through shows, I'm always looking at like just everything, dude. Just like I like great like I bootstrapping. That's really cool. It's a great experience. It was amazing. Like smells, you know, do it and you're good. And like just start making it out. It's a very, especially multifamily, it's a very long deal cycle. So like the shorter timelines and stuff like that, like kind of like drawn to. It was kind of changing in my senior year, but basically my senior year I was kind of like now I feel like I've had a fair bit of like diverse experience. Like, zero responsibility. Like I have money saved up, no rent, no obligations. I basically right now I'm working on experience
I don't know if you know, but
also
Rutgers
investor
Center for Real Estate has a really tight partnership with Walker Mills. So I don't know if you worked there one in the future, but having that, just that name on your resume, like if you want to work at Walker Mills, like
it's growing very
I feel like it's already,
like the
I don't know if
testing
it's
markets
easy
with
enough,
newer guys.
but there's already a strong relation. Like
can be very like
Walker Mills
very
is
like risky, but
like they did it,
fastest growing
I
county
think for the last few
in
years.
New Jersey.
Like they did it when I was a senior. I got an offer from them,
Also,
but I decided to
really
take
just
it
because I was trying to
you offer with an network.
also
So
like you said before, like with the like
that's
programs
really
and stuff, like
and JLL is a
that are
it's like
busy
world class
for a while,
brokerage,
typically do
very
like our
attractive
conferences
sector.
for a while.
So So the newer wholesalers are people that are going to be people that also are kind of looking at these deals like, dude, there's so much stuff I think so a lot of the wholesalers want to do it just to want to find good deals for myself, but also like if I can do it out. So I'm gonna do that for a while. We'll see how it goes. Again, worst case scenario, I had enough development experience in like networking and finding angles from
You're the rep.
like planning and events and kind of show.
We live together.
I was like, okay, I just love that like hustling and do these events.
Well, it's good.
So now you're in race finals?
I'm seeing it.
Practically the last 2 weeks.
I'm still walking. I'm not sure what's best to do.
Have you found something full time or are you trying to like
As long as you do this full time.
Bro, I feel like there's no what I'm confident. Bro, my day after was really like part-time. I had road interviews on Sunday. Then Monday, I woke up, I was speaking to my girlfriend, I woke up, I came to Rutgers. So that was my comment, hang out there, just watch the match. Came to macro. Then I drove to the golf course, played golf. Then I came back to Rutgers. I played ping pong with my friends. And then I played poker. I got like 1 in the morning. And I was just like, I was fried. I went to bed, I woke up, I didn't know where the hell I was. I was like, bro, my alarm was like, I couldn't get out of bed. I don't know why. I just love like, I was so stressed out and sad from all the stuff. And then I did like a bunch of shit. I think I woke up, bro, I literally was like zombie until like 11. And then 8 hours, we gotta go to the gym, like wake up. And at the gym, I literally was like, felt like I was gonna pass out and I was benching. And I was like, bro, I didn't like, and then I did my top set, and like on the first time, I was gonna go for like 3, and then I got the 3, and so the 4 was like decent, and then the 5th one was
real estate? It's
a struggle. It took me like literally like 15 seconds to get it up.
you kind of pave your own way. Hang on.
My leg like, I was pushing my leg like slipped back. And like, oh, my eyes were like bloodshot. I was about to pass out.
You know, like, if I were to, because I once right now, I do all in. So, even though like my friends all in the gym, because I still want to listen back. So I'm like, if I don't start either way, so I got a few months to get some numbers on the ground. You know, within a few months, we'll see.
Like,
I don't know where I had before like the last few months I was like trying to work on just focus on more like the construction management and finance side because like, I knew people that wanted to invest. I also have experience in construction management. Having done those a few times, once on my own, once with that guy. Just don't like cold calling, but just numbers that I was like, no, damn, like one from doing it full time. So now I'm kind of like researching not just data stuff, but actually researching just things like AI, SMS texting, like send out a bunch of texts for the initial like back and forth, like you're interested in selling property. What's the bed's path, condition, kind of general stuff. Okay, we'll reach out to you. So how do you do that with AI? Like follow calling. So I've tried that. That's been pretty interesting. Yeah. But again, right now I'm just like doing the research on like talk to people, like big guys, like LLCs, which is once I graduate, that's gonna be my practice. Then do that for like but it's exciting. It's exciting.
Basically, yeah.
Pretty down the road. So, not even thinking of the future of what you're doing. So,
Where are you buying?
yeah, Jersey City.
Back then they didn't have like
I was thinking more so different parts of PA, a bit more central Jersey, you know, a bit more transit down there, PA. Yeah, about Philly, where there's good international fun. That's what they should. That's what size it is. I like it. Over time,
do you understand that like stock price doesn't mean like he's looking at stock side of that? Oh wow.
yeah. Real estate just
Should be $200 is really expensive. The stock price.
at some point now it's about
Market cap.
And it's
Just
like
collecting
$200 like $100
I mean, how you can make per share? I'm not gonna share this, so probably.
I know that's the most
Jack? He's like the alumni, like actually grilled people on the
Sure, I
text.
was excited for
Dude,
it.
probably.
You know, in the meantime, yeah.
Did he?
Yeah.
Like the last one. He might, but like, if he doesn't, because
Personally,
they
I
ask
think
you to
I'm
follow
gonna
up on other shit on market cap.
Oh yeah.
Nah, you might be fine, man. You'll see. But like, it also like, if you don't know, he's probably like,
I think that's
well then, yeah, cause there's like a bunch, like, there's amount of kids like that, I think. So that's another thing, like, even if you, even if you do like a great, then I'm probably, you might get in though. You never know. I think I heard about it. She got like a free, you didn't know what it was before.
yeah. One day it's like, all right, let's take it up.
Did they ask you that?
Alright,
Yeah, whatever the slides.
something
At all, like, just stop.
running with opportunities.
Do that.
How did he make it through the second year? I wouldn't even believe it.
Honestly, taking a shot. Asking if he's curious.
I almost wish I did.
I appreciate you coming. Apologize for the return.
No, he's probably so key.
I love this.
Everyone has it.
Yeah. Enjoy the drive. Oh, dude, please take like pies if you want. It is like I'm so sick of eating pizza so much.
Eat red?